The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Let's move into the equity markets now, and we're going to try and price a few things here. So again, this is going to be very interesting because we have in front of us here the Euro Stoxx. It's a sample now from the Euro Stoxx 50. So if you're familiar with the Euro Stoxx 50, what it is basically, it is an equity index consisting of many European stocks, of course, from mainland Europe, including the UK, I should say as well. It has a few UK components. However, now I just have a sample here. We don't have the full 50. We have a good sample. And often traders look to trade this and find a correlation between, let's say, the German DAX or the French CAC. So just think about that. I mean, why is the Euro Stoxx 50 strongly correlated to regional European stock markets? Okay, and if you look across the sample here, this is the relative sample, and this is actually taken from Eurex, which is the futures exchange from today. But why can we really ascertain that this is very strongly correlated? And it's quite simple, guys. Well, because we have a strong makeup in stocks here. If we're looking to trade, or perhaps looking to spread trade, which I'll get into in some detail here, spread trade, the French CAC 40 or the French CAC 40 against the Euro Stoxx 50. Well, we know that we can do a statistical level of inference or measurement to see how correlated they are. Now, if they are very, very correlated, which they are, of course, and we get a figure back of, let's say, 0.92 or 0.95, that tells us that they're very, very correlated. So then we can look for opportunities. Let's say the market's open tomorrow morning at 8 o'clock, and for some reason the French CAC 40 opens out of line. It opens 30 pips down from its closing price, while the Euro Stoxx opens at the same price it closed. There is a trade there for us. We can look to buy the French market off the open. Again, top German companies, we have Allianz, BASF, Bayern AG, BMW, Daimler, Deutsche Bank, Deutsche Telekom, E.ON, the energy company again. So some top components that are actually in the DAX as well are making up a large portion of our Euro Stoxx 50. And again, top Spanish companies, we have Banco Bilbao, we have Banco Santander, and down at the bottom, Iberdrola, which is again another very large energy and oil company, making up a large part of the IBEX 35. And again, maybe trading opportunities there if something trades out of line or gives a signal to buy the market, or perhaps short the market, of course, if the markets are weak. So this is literally what you can see here with our Euro Stoxx. We have the markets trading, and I've taken a long sample here. They are all attractive European business investment opportunities, okay? Because the markets are performing well at the moment, they are very attractive in terms of the rate of return over a long period. They share the same risk premium, so they're within the same bracket in terms of, like I just mentioned, the bond markets there. Let's say the equities are performing over 6%. These will collectively be within that bracket. So we'll look for opportunities to trade this risk premium. And they all reflect fundamental health of the European economies, okay? That is effectively what we're doing. And we can see something perhaps if there's a very strong correlation with these two markets over the long term, and let's say there's some news flow that will cause some dysfunction or cause the market in Germany to sell off for a period of a week. Now we're going to see if that's the case. We're likely to see European weakness across the board. But if it's particularly weak in Germany, of course, we might look to simply follow that momentum to the downside by selling the German market and then looking to perhaps by the other markets. And again, we're starting to talk about spread trading, which I'll develop throughout the webinar. Just it gives us an added level of mitigation of risk and allows us to effectively follow the move of weakness with some element of protection there across markets. So you can see the charts here. We have the Euro Stoxx 50, the IBEX 35, which is the Spanish index, and the German DAX, all trading over the long term, quite relatively correlated. Again, you're going to see these correlations become much more tighter in terms of their correlations in the short term, and then the correlations will start to widen, as we say in financial trading, or dissipate. They'll start to break down over some short-term periods. Now let's go through statistical inference, and this really brings us on to the study of correlations itself. Okay, this is going to be fantastic for your understanding of how, interpreting how markets are correlated and how to use that to your advantage. Now, correlation, to calculate the correlation between the key US equity markets, that is, of course, our objective. Again, positive, as one variable increases, so does the other. This is our assumption. Negative, as one variable increases, the others decrease, so there's a negative relationship. Or do they have no relationship at all? Okay, so the key US equity markets, which obviously no relationship entails no movement in one variable cannot be predicted from the other. So these are our correlations. Correlations closer to 1 will have the strongest positive correlation. Correlations closer to -1 will have the strongest negative correlation. Okay. In observing and collecting data on market performance, we are able to statistically infer exactly how correlated markets are over a period of time. To do this, we must observe a well-informed distribution sample. So what is our objective today? What is our objective when we're going to look at these 3 key US equity markets? Well, we're going to try and calculate their correlation. Okay, let's define their correlation. We're going to choose the Nasdaq 100, the Dow Jones Industrial Average, and the S&P 500. Our distribution sample, of course, daily open closes prices, and to give us a shorter time period, we'll use 4-hour candle open closing prices. And of course, guys, we have to use the same distribution sample for all 3 markets. So effectively, this is what we've done, guys. Okay, now we're going to go through this in a lot of details here, so do bear with me. It's a lot to take in, but this is our statistical inference. This is where we derive our level of correlation. This is all very easy to do, guys. You'll be able to do this on Microsoft Excel yourself. What we've done here is simply choose our 3 markets, okay? So Dow Jones Industrial Average, the Nasdaq 100, and the S&P 500. We've chosen our sample here, 14 periods of data. Okay, now it is advised, of course, to use much more, but in terms of just explaining this to you and showing the level of correlation, it does still bode well and give you your statistical information. Okay, so what does this table tell us before looking on to the correlations? Well, we've taken 14 samples here. Each sample is just 1 candlestick, okay? So we're using the daily candlesticks first of all. We take the sample from the open price of all of these 14 days and the close price of these 14 days, okay? We do the same for the Nasdaq, the open price for the last 14 days and the close price of the last 14 days, and the S&P as well, respectively, for the last 14 days. Then we move on to zooming in on the price action. We use the last 14 candlesticks for our 4-hour price patterns, okay? So the open and close price of the last 14 candles for the Nasdaq, Dow Jones, and the S&P. And then we do our correlation study, guys, okay? So right across here, so we simply select our correlation study on Microsoft Excel, and we just calculate here. So what does this tell us? What does this tell us in depth, okay? So let me just take away some of these annotations here. Well, first of all, we have our open correlated. Now you can only do 2 samples here to get your figure, and then you'll have to do some mathematics here. So this is our Dow Jones against the Nasdaq 100, the opening prices, okay? So these are our samples here. That is effectively showing us that all of these opening prices with the statistical inference between prices is effectively giving us a correlation of 98% or 0.98 in terms of statistical inference. That is very, very significant indeed. Very, very significant indeed. Okay, so what's the next study we've done? Well, we've chosen to do the open here of the Dow Jones again with the S&P. So again, Dow Jones again with the S&P, just on the daily price action. And again, the open prices are suggesting a stronger correlation of 0.99 in terms of the opening prices day by day over the sample period of 2 weeks, 14-day periods. And then we have a statistical inference of a correlation coefficient of 0.99. Very, very, very strongly correlated indeed. Then, of course, we have the opening prices for the NASDAQ and the S&P. Are they correlated, of course? Well, absolutely, they are 98%. Again, we've just used the reference point for our open. And that's effectively what we've done across our correlation study. So we did the sample again, both for the closing prices of the daily candlesticks for our 14-day distribution. Okay, effectively what we're getting is a little off the boil, but still very strong, 96 or 0.96, 0.99 for the Dow Jones and S&P, very strong, and the NASDAQ and the S&P 0.968, so 0.97, very, very strong in terms of correlation. Okay, so we've simply added the averages to these figures. Okay, let me just take away some of these annotations yet again. These are our averages, guys, here for our 3 opens and our 3 closes, and again we're simply adding these and dividing by 2 for our correlation complete for the daily price action. Okay, for our daily sample we have a correlation between all 3 markets, guys, of 98 or 0.98. okay, so they are very, very correlated over the past 14-day periods. Now let's break it down to shorter time periods and see if you can notice something. I'll just ask you a question here as we go down through the sample period of the 4-hour price action, okay, for the Dow Jones, the NASDAQ, and the S&P. Can you notice something, guys? And if you do notice it, can you try and explain, of course, what sort of factors might play a part there in actually causing those figures? So let's start off with, again, the Dow Jones, and we'll just go through them quite quickly. Dow Jones and the NASDAQ here in terms of statistical inference for their correlation. Well, using the 4-hour price patterns, of course, observing the 4-hour candlesticks, we have a correlation here of 70. So 70. Okay, so that's quite strong. Again, still quite a positive correlation. Again, the Dow Jones in the shorter term with the 4-hour observation, the Dow Jones Industrial Average and the S&P 89, very, very strongly correlated. Again, the NASDAQ and S&P 88. So very, very strongly correlated in terms of their opening prices in the short term. 82 is our average. Again, we do it for the close prices. Again, 85 or 0.85 is our average. And as we combine, our total factor for the short-term price study is 0.84 correlation. Okay. So, guys, again, I see the chat box starting to pile up there with comments coming in because it's the short term. That's absolutely, well, that's the right answer. Of course, it is. You know, you've noticed that they're not as correlated within the short term there, Matthew. That's certainly the case. Could you think why that might be the case, Matthew? Short-term volatility is the right answer. Yeah, absolutely. Short-term volatility is going to cause these markets to move and smooth out. Sorry, I suppose that volatility will cause some angst amongst their correlation in the short term. Again, we're looking to define a correlation in terms, and that's why you have to use different sample values. You could, of course, if you're looking for the best correlation study, use a very large distribution. You could use, of course, daily candlesticks, 4-hour candlesticks, and 15-minute candlesticks as well, just to show you, perhaps if you're a scalper, which of those markets are more correlated in the short term. Okay, so that is a correlation study with the 3 key US equity markets. And the question is, what does this correlation study teach us about the US equity markets? Well, many things. It teaches us that they are they share a total correlation. And again, this is very, very recent, up until today's date, total correlation of 0.91 as we average out all samples here from our opens closes for both the daily and for our price action, averaging out a total correlation of 0.91. So they're very, very strongly correlated, these US equity markets. We can see that with our correlation study there. Okay, now what does that tell us about trading these markets again? Well, if one market, let's say tomorrow the market's open and which can happen at times, of course, we've looked at the short-term volatility in markets. The Nasdaq trades down 40 ticks or 40 pips, and the Dow Jones trades up 12 pips. There is a trade for you there, of course. Let's see if you can think of that trade opportunity, because we'll discuss it just as we go through these slides. So let's move on then to really getting into the depth of developing profit opportunities. Okay, so one of the best things about financial trading is that there are many different ways to make profits in the markets, and I wholeheartedly agree with that statement. Okay, there's many different ways to trade the markets. You know, it's often a misconception that financial traders simply buy a market, the market goes up, then they get out for a profit. Or reversely, they look to sell a market, the market goes down, they exit for a profit. That is not often, it is often the case, of course, but it's not always the case. There's so many different ways to make money in the markets. Most traders simply focus on buying something and selling it higher, as is suggested, which is fine and a fair assumption to traditional trading. However, trading correlated markets may give you some insight into engineering your own profitable trades, which I just hinted on there before. Let's take, for example, the European equity markets again. We'll go back to the European stock markets and we'll use an example. The monthly German unemployment release was a big miss at 6%, in contrast to an expectation of 5.2%. Okay, so it's a big miss. The markets are experiencing a lot of volatility in the trading day. How could we perhaps trade this market? Okay, well, let's assess it. We have the Euro Stoxx here 50 and the German DAX. Okay, again, let's go through the figures here. Well, 6% unemployment announced in Germany. We know that the DAX will be very weak, a very weak market during the course of this trading day. Okay, what we may look to do is spread trade these markets. So I'll walk you through this. The aim is to profit more from the DAX 30 weakness whilst avoiding the volatility. So we're looking to mitigate risk with correlated assets. So we sell the DAX, okay, and we buy the Euro Stoxx. That might raise some questions. Well, the markets are going to be weak today. You know, Robert, why would we like to actually make that trade? Shouldn't I just sell the DAX? You could, of course, look to sell the DAX, but you're looking to mitigate risk. You're looking to perhaps protect yourself from any sort of movement. You know that the German DAX is going to be weaker than the market. So let's say there is, you know, some weak price action, some weak trading during the morning session, but then the markets are very strong for the US Open, and the markets actually start to trade up, and they both finish on respective medium highs for the day. Okay, well, effectively, because you have mitigated that risk, the one that you have decided to go long, i.e. in this example the Euro Stoxx, you're going to outperform the DAX because the DAX is weaker. So you're avoiding all that volatility in the markets and you're trading the weakness in the DAX. So this is simply what you could do. You could look to sell the DAX, buy the Euro Stoxx. Again, if there's weakness across the markets will move down. You'll take a 120 loser in the Euro Stoxx, and you'll take, say, a 270 euro winner in the DAX. That's a hypothetical trade, but of course that is how you look to trade these profit opportunities. Effectively, that delivers 150 euro profit. Okay, so that is effectively one example that you can develop your trading strategy. And again, one of the reasons why we went into so much analysis with sector trading, when you understand your sectors and your level of exposure for different equity markets and capital markets, you'll be able to trade these developed profit opportunities. Let's look at the oil market as well. So, well, we've got WTI oil, we've got the US benchmark, we've got the UK Brent benchmark as well. Now, we know these markets are very correlated. They are effectively the same product, but are there trading opportunities, different trading opportunities that may arise? They're both based on the same commodity. They both move as a result to supply and demand, and they differ in relation to more regional issues. So there's some alarm bells going off already. They both differ in relation to more regional issues. So I would imagine this new concept now with Iranian supply is going to have an effect in this particular spread trade, okay? Because of course there is not going to be any Iranian supply entering the US markets, but of course Europe is still holding up their end of the Iran deal, and Iran is still able to do business with Total and Iberdrola and many of these big European oil companies. Okay, so there's going to be something playing out in this market, I would say, over the next few months. And that is a result of different regional issues for these two markets. So what could you do? Well, we have these two markets here in front, the two benchmarks. Why could this provide trading opportunity for us? Traders can choose to both buy and sell the two markets at the same time. So we're looking at a spread trade across the markets. And again, on chart, you can see there's quite a strong move in the UK oil. While at the same time, there's still a move to the upside in the US WTI oil market here with the black line, but it's not as significant. Just not as significant here. How could we perhaps trade this? Well, here's a hypothetical example again. We look to get long this market. We could suggest that our analysis says these markets are going up, but there's going to be likely a lot of volatility. How can I protect myself and get a trade off? Well, let's say we make 203 pips. Let's say we actually look to buy UK Brent and sell US crude oil. Okay, so we're short the market, the US crude oil market, when it's going up. We effectively take a 203 pip loser, okay, in the US crude oil market, but we are long the Brent market. Again, we are effectively able to gain 335 pips given its outperformance and strength. What we've been able to do there, guys, is avoid all the volatility in this move. Really, to suggest a trade, we're trying to avoid the volatility, and it gives us 132 pips profit on the trade. Okay, and again, oil is one very good example because, well, the market trades in price of dollars, so it is one very unique market, the oil market, because the commodity itself is priced per dollar per barrel of oil, of course. So there's no spread ratio or anything you'd need to try and figure out between the markets. You'll simply be trading the same trade size across these markets. So again, one opportunity there for you. And again, we're looking to develop profit opportunities here, going back to our negative correlation here in the US dollar index and the gold market. They share a negative correlation and have many different factors that price each asset. We can see both weak or strong correlations depending on the data. Okay, so what possible trade could you look to get across these markets? Well, we see over the long term, there's a very inverse correlation or negative correlation between these markets. Okay, so we're at this relative price action right now. So here is the US dollar index around these lows, and we know now it's starting to tick up around here. Okay, so we've broken these levels. Let's say, for example, the current situation where we know the US Treasury yields are now delivering 3.1%. Okay, so that is going to increase a lot of demand for US dollars. Okay, so what we could do is say, well, finally we're at a pace where interest rates are starting to increase. We know that we're pricing in another 2, if not 3 interest rate increases in the US this year. I have a play here. I would like to get long a position from now until perhaps December or the end of the year. Take a large position. I'm going to get long the US dollar with this trading action to the upside, and I'm going to protect myself with perhaps a trade in the gold market again to try and avoid that volatility. Now, of course, the rational thing to do is, as the dollar trades up, you could look to short the gold market for profit opportunity again, to look these to come back there for the negative correlation so that they trade in opposite directions. However, your trade is for US dollar strength. Okay, that's your idea. So you're looking to get long the US dollar market as it trades up. You'll take a relatively big position in the US dollar market. However, you'll take a small position to the same direction in the gold market just as a hedge. Now, this is delivering on hedge fund trading as well. It might be a lot to take in at this stage, but I'm just trying to get you thinking constructively about how to trade, how to develop these profit opportunities, because you can of course do this in the short term. You can do this day trading, of course, if you see that there's no movement in one market, or one market is leading or lagging the other. So it's to start to get you really thinking positively about developing your own trading opportunities across markets that are correlated, not only positively correlated, but negatively as well. So again, with this trade, you could look to take a very short, a very small trade in the gold market here, which would be of the same direction, so a small long trade, which is likely to be a loser, and then a very large long trade in your US dollar as well, given that you're going to see the US dollar rise, you're going to see this trade to the downside. The idea is hopefully you'll take a smaller loser on the gold market, and of course you're going to outperform with your idea that the US dollar is going to severely increase. That's effectively what we've seen as well over the last month or two, so it has played out as a very well-informed carry trade. Okay, so a lot to discuss, a lot to talk about. That brings us to the lesson summary here. What did we learn with this lesson? Well, market correlation exists among similar markets and asset classes. We can gain a trading edge by understanding these correlations in relation to how other markets are trading. Okay, so if we look across the US equity markets, and they're continuing to trade up, they're very strong for the day, yet we know, let's say the FTSE 100 has a strong correlation with the S&P, for example. Okay, let's say they're trading very strongly, and then the FTSE just can't seem to show some strength. If those US markets turn around with some news event and start to sell off, well, there's your opportunity to sell the FTSE, because it is underperforming for the day. It's showing some weakness in the equity markets that were performing during the course of that day. So many different opportunities to arise from trading correlations. There are many different methods to make money trading in financial markets. Market correlation can help us not only to diversify our portfolios, but also to diversify our trading methodology. That's very important. We discussed spread trading, lagging trades, leading trades, to really think about the insight into getting involved with market correlations. And we can do our own correlation studies again to identify exactly the correlation between markets. Okay, so if you'd like to choose, maybe some more exotic markets there, maybe some of the Asian equity markets, or Australia or Sweden, of course, some of the other external European markets that are correlated, you're looking for ones that are going to perhaps share perhaps less correlation with your Euro Stoxx or another market, so that if there's a real significant move, there likely to be more volatility in that market, but you can still spread it off with another market as well to protect yourself, albeit with a level of risk involved. Okay, so that brings us to the end of our Become a Pro course today. Very informative indeed, and a lot of comments coming in. Thank you for that. So congratulations, guys. We're finished with our Become a Pro lesson, market correlation. We're getting through them, of course, with week 4 here. Look forward then to tomorrow's lesson. We'll be going through quite a lot of detail in terms of risk management and risk aversion, so that's absolutely fine. Look, I'll leave you for this evening. Thank you very much for joining us here at Forex Academy. It's been a pleasure. Next time, bye for now.